Good morning. This is Mike and Corey with today's update. We're going to hit a few topics today. We're going to talk about, how the market reacts with this rate cut that just happened last week. We're going to kind of see what's happening so far. We're going to talk about optimism versus skepticism in the market, how that works out. Just so you know, when everybody gets too optimistic, that's when we usually have a big fall. But Corey's going to cover that, and then I'm going to show a real short chart that kind of shows you the year-to-date returns against small, mid, and large cap, and then just what's happened in the last couple weeks. But before we get started, I'll remind you this is a financial education presentation. You must do your own due diligence on anything that you hear. There's more disclaimer information found on ankerstarwealth.com, and the opinions expressed are mine and Corey's alone. So let me show you my favorite, Wall Street Journal, article. Actually, this is the chart, but here's what happens to markets when the interest rates fall. So let's just take a look. So let's just look at the last, let's say 25 years, if everybody can, 35 years, we're investing way back when. But, when the Fed starts cutting the rates, there's a reason why. It's time to go from a restrictive policy to a less restrictive. It's still not to, an open flow of dollars here. But you can see the history. And I know Corey touched a little bit on this last week. And you can see sometimes the year after is extremely positive. I mean, especially look at in 2000 or 1998, if you remember investing back then. I had a lot smaller portfolio back then for that nice 22% gain. But even as recently as July of 2019, when the Fed started cutting rates. But you can also see it's not as easy as saying it always happens, because in 2001, you had that dot-com bust, the Fed cut rates, the market still went down 10%. And then in 2007, which is that great financial disaster, there was a lot in play then, a lot more in play then than I believe there is now. It didn't get any easier if you remember those, when the financial systems were froze up. But you can see that generally it's positive. I think Corey's information last week showed that it's positive. But this was a significant inflection point last week that has begun, and it will continue. It's not like it's a one-time rate cut. This is going to continue over the next at least 18 months. The other thing I wanted to show real quick is, how did the markets react leading up into the trade? I mean, into the announcement and then afterwards. So what I'm showing here is just a really small, I'll make it a little bit bigger for you. A chart that shows large cap, mid cap, and small cap. And the top line is what it did in the last 2 weeks, and then the bottom one is year to date. So you can look and you can see that large cap year to date is the place to be, large cap growth. And that's really primarily where we're at, is large cap growth. I mean, we have a diversified portfolio, but if it's overweight anything, it's large cap growth. So that's been good to be in, right? I mean, surprisingly, value has lagged growth for quite a while, even though I certainly understand the reasons why you would want to be in value stocks. But what happened in the last 2 weeks is you see the shift to mid and small cap as far as the gains. So you could look at small cap and say, wow, the last 2 weeks, I wish I was all in small cap. Well, yeah, I mean, everybody can say that, but if you were in that year to date, you'd be lagging large cap by quite a bit. So, and we do have a diversified portfolio, so you do have some small cap exposure, but it's certainly not overweight. And that's really a good thing to see these numbers go like that, because large cap has done so well that we're seeing actually, some, I don't want to say sector rotation, but really just an expansion into the mid and small cap companies for all to grow. Investing, we can all win together. We don't want just large cap to dominate all the rest. Some of those small and mid caps will be the large caps 10 years from now, 20 years from now. We don't know who the next NVIDIA is, or the next, pick another company, Meta. I'd say Microsoft and Apple have been in business a little bit longer, but we don't know who 10 years from now, 20 years from now, some of those small caps are going to be the next ones, and we want to invest in those too. So with that, I'm going to turn it over to Corey, and we're going to talk about skepticism versus optimism in the market.
Okay, yes, thanks, Mike, and that was great information. Let me see. Can you see my screen now?
I can.
All right, so just wanted to just talk about a little bit about market cycles. So we know, and it would have been nice if they told us here in January of 2022, hey, you're entering a bear market, but they don't tell you that. You find out after. So we found out, oops, we entered a bear market late in 2022, and they didn't tell us the bottom either. So wish would have been nice to know that, but we did bottom out in October of 2022. So that was a greater than 20% decline, so classified as a bear market in the S&P 500. We've now been in a bull market since October 2022, and we've run quite a bit. And usually if you've been in a bull market for a long time, like we have been right now, people start wondering and they're thinking, okay, when does the party end? You don't want to be the last one at the party. So there's this famous saying that from Sir John Templeton: bull markets are born on pessimism, grown on skepticism, mature on optimism, and die on euphoria. So I was curious, Mike, when you're out there, and this is a sentiment chart, this is not a data chart, but sentiment chart, and when you're talking to people out there, what are you getting? What energy? What sentiment?
I definitely get some skepticism. So I'll tell you that's where it's at. And maybe it's because, we're coming into a presidential election. We don't know how that's going to be impacted. I get the feeling because the economy is slowing. It definitely is. Inflation's come down, but the economy's slowing. I talk to business owners that saying, hey, things are slowing down. I'm getting concerned. I do not sense that euphoria. So hopefully that means that bull market, we got plenty to run with it. I agree. Bull markets, like the famed quote was, when the, I don't know, the shoe shine boy in 1920s, when he was like, yeah, I'm buying stocks, like everybody is in, then they knew it was time to get out. Like, and I do not sense that everybody is like, oh, I'm diehard in, I'm so solid in the market. So I'd say we're in the skepticism part right now.
I'm similar. The sentiment that I'm hearing out there is similar. I will say though, I would put us right in between skepticism and optimism. I do see people observing gains that have been, that other people have experienced, and they're not chasing it, but they're thinking, wow, that's really good, I want to participate too. And and it's a very optimistic look at, let me in the too. So that's kind of what I'm seeing out there. It's important to note, this depends on who you talk to, and it depends on what part of the market you're looking at. You could look at, as Mike was showing, small caps, large caps, and there can be a little bit of divergence just among different assets, on that sentiment chart. But in general, I'm with Mike. I don't think we've reached euphoria
And
yet. Now,
let me
yes,
throw in too. I think some of the things that kind of scare people or make them nervous is when the market does a quick 5% drop, and then it's that feel like, oh my gosh, like it just dropped 5% that quick, which I hate to say is normal. And I've said on some of our other videos that volatility is our friend, and it may not feel like it, but it is. It gives us a chance to buy things on discount, and it also, things that are more volatile go up higher. You want no volatility, buy a CD, put your money in your savings account. There's no volatility, and you don't get as much of a return. Volatility is our friend, but I think that's why there's some skepticism slash, and this will lead into your as far as money and money markets. When the market drops, if you're courageous, that's the time to buy, get it on sale. So go ahead.
Yeah, and Mike, I love that. And you can see lots of little drops here, right? And this is just in the last 5 years. I kind of think of it like if if I'm building a portfolio, it's kind of like going to the grocery store, and I'm happy to buy. What do I like to buy? Well, we buy some milk every week, Mike, right? We buy some milk. I'm happy to buy milk at full price, and I'm happy to buy milk at 5% off, right? I'm just trying to build assets over time, and that's what we're trying to do in our portfolios, building high quality portfolios over time. All right, I did want to show one last thing. So, are we going to get that big drop? And I don't know why this chart kind of betrayed me a little here, but you can see that this is money market funds above 6 trillion. And yeah, make sure I have that right. And we don't really ever see large drawdowns in money market funds. I was looking at this chart thinking, man, it'd be a nice company to own, really, based on the chart. But we don't see big drawdowns here. But we certainly do see some peaks correlated with recessions. And, you know, you don't know that in the moment, but of course we aren't in a recession right now. And there's a lot of money on the sideline that could come back in if we do get that 5% discount that Mike was talking about. So anyway, a little market.
Well, here's the thing with the money market account slide that you were showing. The last several years with U.S. Treasuries and, being able to get a return over 5%, you say, wow, 5%, basically risk-free. That feels pretty good, especially after all the 0 or 1% years. But as the Fed just reduced the rates by 0.5%, that's going to start coming down as that plays out over the next 12 to 18 months. If you can only get 3.5 or 4%, are you going to be like, yeah, maybe I better start to diversify back into at least bond funds and some, some stock funds. And that's the boomerang effect that, Steve has said many times, the water flows somewhere. It has to go somewhere. So, it'll be interesting to see what happens. $6 trillion in money market, that's like, yeah, that is a lot of money.
That one stopped me in my tracks there for a second.
It's like, if we could take all that money, would it pay off all the U.S. debt? Unfortunately not, but it certainly at least knock it down a lot.
Absolutely.
Well, thanks everybody for checking out. We'll have more later, and we'll see how this market continues into the presidential elections. I truly believe that skepticism, optimism, it doesn't matter which party you're in. Right now I think it's a 50-50. So guess what? You're in that. I don't know. The markets will react positively at some point as clarity comes about. So we look forward to that. But what is it? November 5th? We're like 6 weeks away. So I'm sure that's going to be the major topic, at least for the next 6 weeks. With that, have a good one. Thanks, everybody.